This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Paul Sweeney. Join us each day for insight from the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. What you do when you have a jumble of a day like yesterday is you call somebody that can synthesize it across economics and markets. David Rosenberg coming up later, but right now, Michael Darda with us with Roth MKM, their chief economist and market strategist as well. Michael, we haven't done it yet this morning. Let's dive into the inflation statistic. Do you believe, as I heard others, Robin Brooks, I thought was outstanding on Twitter last night, that some of this is a January effect where you get jump conditions in certain service sector inflation subsets?
Hi, Tom. Thanks for having me on. Look, this was not a good report. For the January CPI, the core number accelerated pretty dramatically. Mm-hmm. And, even if you're stripping, there's been a lot of talk about, housing and the rental inflation. Even if you take that out, the Fed looks at a gauge of non-energy services prices, excluding housing, and that accelerated pretty dramatically. So the markets did not take this well. When you're priced for perfection right, and you have a setback, then you see a dump like we had yesterday. All of that said, let's not go into a complete panic over one number. The Fed does focus on the PCE deflator, which is a different index. And there's been a pretty big gap between the two. If you look at the core inflation readings from the PCE deflator over the last 7 months, they're basically in line with the Fed's target, 1.9% average annualized growth. But the CPI, core CPI readings have been much higher, and the divergence is about triple the historical average. Usually the CPI runs 30 to 50 basis points above the PCE deflator, and we're seeing a gap about 3 times as wide now. So if we take a step back, I think that the CPI data could be overstating the inflation problem here. Nominal spending, if you look at nominal final sales to the private sector, over the course of time that we've had these better core PCE readings, we've essentially slowed the trend. So if aggregate demand, total spending in the economy has slowed the trend, then that's going to take the inflation pressure off over time. So let's not completely go into a full-blown panic over one number here.
And Michael, I'm looking at kind of how the market traded yesterday. I mean, the indexes were off, kind of 1.5%-ish. Volume was kind of in line. It seemed like a reasonable kind of market response after kind of the big rips we've seen in November and December, and even some strength. And maybe it's just a healthy day in the market yesterday.
Oh, no doubt about it, Paul. No doubt about it. I mean, the run that we've seen, especially in the S&P 500, led by infotech and consumer discretionary. Basically, it's 7 stocks dominating the index. I mean, these valuations have really become stretched, and we have a momentum market. It doesn't take much. It just needs to be some change of the narrative, whether it's sustained or not. And you see what we saw yesterday. So you just can't have a straight-up market. We're starting to move into pretty unhealthy territory where you start to get worried about what could be on the other side. I mean, these kinds of valuations tend to be rarely seen in history and never sustained. So we're at levels now where you're priced to perfection, and you do have to worry about threats to the perfect narrative unfolding.
So part of that narrative, Michael, is kind of the Federal Reserve, obviously, and I think the market's expectation is that March is clearly off the table. Fed Chairman Jay Powell was pretty clear about that on his recent comments. But now I guess the focus has shifted to May or June for the initiation of some rate cuts. Did yesterday's data kind of change your view? Where do you think the Fed's going to come out here?
Yeah, it's interesting. I mean, our thought was that the Fed was probably going to push back on the timing and both the timing and magnitude of the easing expectations that were in the market. Even if you think the economy is going to underperform this year, I mean, the Fed's framework is to look at slack in the labor market. We haven't really had a material increase in slack in the labor market yet. just very marginal. And they're watching things like financial conditions, which, based on our market discussion, have eased pretty dramatically. So I wasn't surprised to see Powell push back. And then if you get data like we saw, with the CPI readings for January, then that just reinforces it. So I do think they're going to be pretty cautious in terms of when they start this process. And, we'll see. Obviously we'll have more data before we get to the May meeting. But yes, for sure, March looks like it.
I'm going to go wonk right now. You can do this with Michael Darda. I'm doing an event, and Michael Darda, a kid comes up to me. And on his phone, he has his email from when he was an intern at Bloomberg, and we were talking about the ambiguity of Hicksian and Slutskian income distribution and substitution effect.
Oh, boy.
We're not going to go over this on Valentine's Day.
Thank you.
But Michael, what's great about this is it identifies a Euclidean ambiguity of our microeconomics. Right now, we've got macro ambiguity with higher interest rates. Can we have a good economy and a good stock market because we pop nominal GDP and get a better revenue stream than expected?
Well, I think that has been the story, Tom, right? I mean, we're sitting here talking about an interest rate structure that none of us thought was likely several years ago, right?
Right.
And so that's really been driven by the business cycle, the vigorousness of the upswing from the COVID recession and the inflationary environment that we've been in. So, if you want to get wonky here, it means that the neutral interest rate, the Vixillian equilibrium rate, is higher in a setting like we've had than in the last business cycle, where we had very slow growth, very low inflation, a lot of deleveraging pressures, right? So this is something that's quite different. What makes this tricky going forward is the Fed actually restrictive now, or is the Fed not restrictive? And there's a big debate about that. People talking about financial conditions are too loose, so the Fed really isn't restrictive. But let's drill into markets. If we look at forward-looking measures of inflation expectations, those have reverted to levels that are consistent with price stability. That was not the case when we went into the early innings of the Fed tightening. Those inflation break-even spreads are telling the Fed they were really miles behind the curve. That's not the case now. So the Fed actually does have the real rate, if you use forward-looking inflation expectations, at pretty cyclically high levels. And I do think that is going to mean the economy is going to continue to slow to, if not below trend. And the trick for the Fed will be the timing on starting the rate cuts. If they're too late, then you get a recession. If they're too soon, then you're going to have persistent inflation.
Easy
so that's
decision.
the double-edged easy decision, right?
Michael Darda, thank you. On short notice today after what we saw yesterday, Michael Darda with us. Sparta emails in and says, Tom, get the sequence straight. Paul, save him.
Yes, absolutely. We can do that right now because people are trying to get a sense here, given that sell-off we had yesterday, kind of what does it all mean here as we think about what the Fed's going to do and what these equity markets are going to do. So we figured it was a good time to check in with Gina Martin Adams. She leads all of our equity strategy for Bloomberg Intelligence. Gina, I guess I was looking at yesterday's trading. It's just a normal, healthy pullback in reaction to a data point that the market wasn't discounting. Not much more than that. Am I being naive there?
No, I don't think you're being naive. I just think there is a degree of volatility in rates markets that's really difficult for the equity market to absorb on a daily basis. There was nothing in the inflation report, frankly, that was terribly damaging for the profits outlook for companies. As a matter of fact, when we look at the long-term scheme of things, CPI holding in pretty steady with PPI decelerating and import prices falling is a great environment for margin growth for the S&P 500. That's been the characteristic that has defined the margin recovery of the last year. So the inflation report in and of itself was not necessarily damaging to the outlook for stocks, but it did clearly create a lot of rate volatility, and the rates market seems to be incredibly frenetic. That is creating some valuation disruption for the equity market as there is some follow through from rates onto stocks. Frankly, though, when we just surpassed 5,000, we had very strong momentum in the S&P 500, a couple near-term breadth breakdowns last week, would have suggested that we were due for some sort of modest consolidation phase in the index anyway.
So here's what I do. I'm only doing this to pretend Gina, if the radio gig doesn't work out, YouTube and CarPlay, I can go work for Gina.
Sure.
Carry her coffee.
Yep.
And Gina, what I would do here is I take 2 standard deviations trading envelope off of the VIX. And the VIX here is at 14.62, doing better than 18 at one point yesterday. Even with the 18 spike yesterday, I didn't get a Fibonacci across the 2 standard deviations.
Lost me.
The Fibonacci was 18.62 center tendency. We didn't even get back to center tendency, and now we're back down to a 23% Fibonacci. The answer is we are so far advanced. We need a huge pullback to normalize, don't we?
Well, we would, and certainly you would normally see greater than 2% down days start to emerge if we were moving into some sort of bigger, longer-term corrective process. These 1% to 2% days, anything less than 2% is frankly just a normal trading day in the world of equities. So to have stocks down relatively modestly yesterday, it's a down day, and we hadn't become terribly accustomed to those down days over the last several weeks of gains. But it's a normal down day in the grand scheme of things. Really, with the VIX, we don't worry about anything under 20. Frankly, long term, you usually see a VIX spike to 20 as indicative of underlying volatility weakness emerging.
I mean, I bought my first shares off triple leveraged all cash, Paul, like 3 days ago, and I'm way underwater.
That's all right. It's all right. You're taking a long-term view here. Gina, we're about 75% of the way through the earnings cycle here. I kind of feel like it's not getting much attention. It's all Fed this, Fed that. What are you taking away in your team in terms of what we've seen in the earnings cycle?
I know you're absolutely right, Paul. It's been a really fascinating earnings season, actually, because the S&P 500 is on track to post greater than 6% earnings growth. The consensus coming into this season was for less than 2%. So we're talking S&P 500 earnings growth at triple the pace that was expected by the consensus. 80% of companies have also beat expectations. That is substantially better than long-term average of 65, and even better than the post-COVID average, which has been abnormally high. So very strong earnings growth, at least relative to expectations. When we exclude the energy sector, which remember, energy is something we've been watching very carefully because it is a net problem for the rest of the index when energy stocks are doing well. Excluding the energy sector, you're looking at 10% earnings growth for the S&P 500. And stronger breadth, stronger recovery emerging for most sectors into the first and second quarter of this year. So it has gone largely unnoticed, or at least uncommented on, as the Fed has taken a lot of mind share. But frankly, the earnings numbers are much better than expected and painting a pretty solid backdrop for stocks right now.
And I know you guys on your team, Gina, look at margins and the trends in margins.
Yeah.
Are these quality earnings from what you can tell at this stage?
Yeah, it's mixed. To be quite honest, it's very mixed by sector, very mixed by industry. When we look at margins, net income margins do appear to be improving faster than operating margins, which I don't want to call it a red flag, but it's something to watch for pervasiveness. You really want to see both net income margins and operating margins improving. Yeah. We're not yet there on the operating margin line, which does suggest that there may be some income statement manipulations that are helping to improve margins. So we want to watch pretty carefully. That said, certain sectors are improving very significantly, namely tech and communications, while other sectors like energy and materials are big drags. That to me is not necessarily a bad sign. Energy and materials are commodity sensitive sectors. They are cost inputs for a lot of the other groups in the S&P. So the index can sustain improving fundamental conditions if these two sectors are the weak spots.
Gina Martin Adams, thank you so much. I want to color this because I think it's generational as we go to Alex Webb in London on technology. You're a kid from, like pretty basic means. You play hockey. You end up, Paul, at the Rhode Island School of Design. And then you invent this strange thing where you have an apartment and you can rent it out. And it's another play story. Of course, it's Airbnb, and this is Brian Chesky we're talking about. And what's fascinating to me is all of a sudden, he's a grown-up. $6 billion share buyback. Yeah. Uber. All of a sudden, they're a grown-up. With the generational, and Alex Webb is so wise, he can do the generational tilt. Alex Webb, is Silicon Valley in a broad sense, is tech growing up?
Yeah, and Facebook's the kind of like prime example of that as well. Meta, they doing massive buybacks as well. I actually wrote a piece just last week where they're really becoming a lot more like Apple. They're realizing that shareholders care about cash at the moment in a way that they perhaps didn't in those heady years a few years ago when it was all about growth. They're obviously they're not exactly value stocks, but there's a massive pivot which, is sensible given the market dynamics.
And we actually saw Meta initiate a token dividend, but kind of a dividend in line with a yield that's in line with Apple. So maybe that's a little bit of a trend there, Alex.
It certainly looks that way, and you think also about all the increased focus on efficiency, which is unfortunately a euphemism in many cases for job cuts. When you look at the sort of average revenue per employee at a company like Meta or like Amazon, it fell massively actually in the years up to the pandemic because they were just hiring with such gusto. What we've seen in the past sort of 6, 8, 12 months is that there seems to be an increased focus on that number, that they have realized that their employees that they're working less efficiently essentially because they have too many of them. So we've seen massive reductions in headcount as a consequence. So
Alex, we did get Uber, another one of those names, one of those gig economy companies that's really come into its own with maybe some new management with Darda Khosrowshahi. Now they've got a buyback here. That seems to validate them as, I guess, adults in the room kind of thing.
Yeah, and it's like, ultimately, it's not a company that's growing anywhere near at the pace it was. If you think about back in 2022, when you had of course, they did some acquisitions as well, which turbocharged it, but revenue almost doubled in a 12-month period. Now the market's looking for a sort of 15-16% growth rate this year, but crucially, it is now profitable, right? That was not the case for the most of its existence, for up 15 years or something of its existence, only a decade. It's not a profitable company. Now, that's why it's interesting as well with Lyft at the moment, because they are expected to post a profit, at least on an operating basis, for the first time this year. That's meaningful. It shouldn't be, probably, given the way we've used to companies, but in the world of tech, it hasn't been a given.
Alex Webb with us in London here on Technology. Alex, one of our emailers, thank you for emailing in, huge Alex Webb fan, and they say, Tom, cut the chat on these rich guys. Alex Webb, are you returning your Vision Pro? Are you just saying enough it doesn't work?
If I was a rich guy, I might have a Vision Pro. I am not. I don't know. I mean, it's quite interesting. There was a video of Mark Zuckerberg basically giving his, in heavily inverted commas, review of the Vision Pro. Surprise, surprise. He says our product is a lot better. I mean, the case I've made before is that actually Apple doesn't need the Vision Pro to be a hit, right? It just needs to make sure that whatever Meta comes up with is not a hit. Because if it sacrifices the next, vector of computing to a competitor, then it's got a big problems in its hands. If smart glasses, virtual reality, augmented reality, mixed reality, whatever you want to call it, if that doesn't take off as a category, it's not really the end of the world for Apple. The problem is that if it does, and Apple's not in there.
Is a non-financial guy, when the financial people say Apple has an ecosystem of, 2.2 billion, Paul? Something like that. Do you see that growing out ginormous to like 3 billion people? Is there just an endless Apple universe out there?
It's hard to see how that happens without really going down into more affordable devices, right? The reason that Apple has managed to continue growing earnings per share at a fair old clip, even as its top line growth has slowed or in fact last year shrunk, is because it's able to sell more of the top of the range devices that are, devices where you're selling 256 gigabytes of memory at a 85% gross margin, right? Whereas the smaller, cheaper devices do not have those sort of margins. So, if you're going to get to that next market of another billion people, you probably need to be in the 100, 200, less than $300 range.
And I think
not a place where Apple's typically played well.
And when we talk to analysts, Alex, it doesn't sound like, let's just take India, for example. You could make the case that, boy, if they come in with a cheaper phone, man, they can get huge market share there. And analysts kind of say, nah, they're going to stick with their high-end products, and wait for the middle class to grow out, similar to what they did in China. I guess that's the way they're going to go there.
It's really fascinating, India, because it's such a price-sensitive market. And if you look at Netflix's experience in that market, where you think of it, we could have 400 million customers there. Well, actually, are you going to get 400 million people to pay, something in the order of $12 a month? Almost certainly not. Certainly not yet. Might be in a few years' time. Now, if Netflix can't convince people to part with, $10 a month, what's the likelihood of Apple being able to convince them to then actually download an iPhone? Buy an iPhone, then download a huge number of apps of, getting Apple Music, of getting iCloud, getting all these things which are the flywheel of earnings that come off the iPhone.
Alex, one final question, if I can. What's the buzz at the Apple store there? Where is it? Covent Garden?
Yeah, I was going to ask, where is the flagship Apple store in London?
Well, I think am I right, Alex?
I think there's one on Covent Garden, there's one on Regent Street. Yeah, there are quite a few swanky locations around
town. What's a swanky
here.
Covent Garden one? I mean, Ferro, every time I go to London, Ferro's hanging out in line there. But, what's the buzz at the Covent Garden store?
I mean, look, from social media at least, I've not been down there myself recently.
He lies.
No, but it's like, everybody wants to try the Vision Pro. How many people are actually buying it? Different matter. Now, it doesn't look like there's a massive amount of supply anyway. So, people want to try it. There's some suspicion that once people try it, maybe you will get more people buying it. But that's something where the price has to come down.
Alex, thank you. Alex Webb, brilliant there in use of cash among these young Turks. Paul, to me, this is a huge deal. I've complained for years.
Now, a look at the front pages. What's making news around the world? Your daily roundup of today's headlines from major publications.
Today's Pitchers and Catchers headlines, of course, always brought to you by Interactive Brokers Bond Marketplace. Access Interactive Brokers' vast selection of over 1 million global fixed income securities. There are no markups or built-in spreads and low transparent commissions. Learn more at ibkr.com/bonds. I got an email from Mrs. Keene. It's not Pitchers and Catchers today.
No?
It's Valentine's.
That's what I hear.
I didn't know that. Lisa, what do you got?
How could you forget?
Happy Valentine's Day.
You too. The first story is about Valentine's Day.
What a shock.
So here we go.
Bob, pick him up in the control room.
And Mrs. Keene is going to love this one. Okay, so the Wall Street Journal is saying self-gifting is on the rise. So spouses are tired of getting gifts that they basically don't like, so they're going to buy what they like. So we're going to the store and we're buying our own gifts. And then you have those who are single, they're treating themselves. You have Galentine's Day. That's a thing now.
Please,
my daughter and her
Galentine's
friends
Day?
had a Galentine's Day party. They have parties. It's all the girls, all the single girls just
Galentine's.
have a party.
What's Galentine's?
Galentine's, all the single girls, gals.
Gals, I get it. Oh, okay. A little slow there.
But it's good for retailers, right? Because people are starting to shop a little bit more. And you even had De Beers Jewelry. They're offering right-hand ring collection instead of
really?
left-hand.
Do they have pinky rings?
I'm sure they do.
Okay. I mean, every girl needs a pinky.
I love this quote in this Wall Street Journal story. My husband is amazing, but he has trouble figuring out my taste.
Sometimes that happens, yes.
Galentine's Day.
You learn something.
We learn every day.
Every day.
Every day. Next.
Okay, Business Insider has this. Apparently wealthy Californians are ditching the state and they're going to Beverly Hills of Arizona, which is Paradise Valley, Arizona. I don't know if either of you have ever been there.
I go to Scottsdale.
Well, I'm sorry.
Yeah.
We did this for Sweeney. I mean, I saw this in it.
High rollers.
Lisa and I would never be looking at this, but, Paradise, Paul, this just says you.
It does. I mean,
does.
golf courses.
Celebrities go
perfect.
there.
Yeah, exactly.
85253. Good morning.
Yep, absolutely.
Right. It's they want the privacy, they want the luxurious lifestyle, lower taxes also, and the quality of life. Yeah,
Is it
nice.
Like it's outside something. Phoenix. I don't think it's Tucson. I think it's more like
between like
Scottsdale.
Phoenix, Scottsdale. Yeah.
Phoenix. What's it like there in the summer though, Paul?
Oh, brutal. I mean, I think it gets even worse. I mean, 100-degree days. Now, you can talk about dry heat all you want, but 110 is 110. So
it's fancy people like you with like a winter home there, and they're there
I think
for
so. I think that's what it. But a lot of people are out there kind of full time now. I mean, you hear the stories about folks leaving California for a variety of reasons, whether they're going to Idaho or going to Colorado and now Arizona. So
Paradise. Can you see it?
Paradise Valley.
Is Bloomberg Surveillance. Tom Keene with no life in New York City. Joining us now, Paul Sweeney in Paradise Valley, Arizona.
From the golf course.
From the golf course. All right. This is from the Wall Street Journal. Apparently, there's a no-fly list for dogs. And your pet could be on it. I don't know if you take the dogs with you when you travel, Tom, on an airplane. But
a lot more people do.
Yeah, a lot more people, especially since COVID.
Yes.
When a lot more people were buying the dogs. And the carriers are cracking down. Apparently, they're banning them for different reasons, whether they bite, whether they go to the bathroom, whether they don't behave right. But they're putting a mark on their record. So when you check in, there's going to be a big flag there that says your dog
when Matt Miller relocated, this is years ago, from New York to Berlin, he posted a picture on social media. His dog, God, I forget the name. It's the worst dog name of all time. But it was a huge dog.
Oh, no.
Had his own first-class seat on the plane right next to Matt. So
but
Bloomberg paid for
Really?
the dog to go over to Germany. So I don't know how that works.
Which Mike could be
You do.
listening.
You pay like $125 or something
Yep.
for the dog.
But what do you do on a long flight? I mean, I'm asking for a friend. We're thinking of taking Vet Bill and Kennel Fee to Paris here to see, one of the offspring misses
a
them
long
terribly. But I don't get it.
They have to fit under the seat in front of you, I think, is the thing. And you have to put them in a little bag.
What do you do
carrier.
4 hours in when the dog is looking at you?
That's your problem.
I simply don't get it. This is the Bloomberg Surveillance Podcast, bringing you the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.